Welcome to this Killick Explains video, and welcome back to my very short series, only 2 parts, on how to compare shares and bonds. If you missed part 1, well, that went out a week ago. Now let's look at part 2. And as a recap, why are we talking about trying to compare shares and bonds? Well, many investors feel they understand shares quite well. They get a bit confused by bonds. They may not have ever held bonds, either directly or indirectly, but both are actually very good long-term investments. So here, I'm trying to reassure, if you like, on what some of the key differences are if, for example, you're putting together a portfolio or a strategy that involved both asset classes. And that's increasingly common and historically common too. So in this video, rather than going back over ground in part 1, which was key features, what I want to look at here is some other aspects of shares versus bonds, predictability of cash flows, role in diversification, if you like, and security or safety. So let's look at cash flows first of all. The important thing from many investors' perspective is that bonds, fixed income securities, carry very steady, stable, predictable cash flows. Once you've bought a bond with a fixed maturity or redemption date, you can literally plot all of the coupons between now and redemption and the amount that will come back from the issuer when the bond is redeemed. Because bonds basically lock their coupons onto what's called a nominal value, typically £100, that locks the coupon in, and that is the amount, regardless of fluctuations in price in the meantime, as bonds are bought and sold in the open market, that's the amount at which they will be redeemed. And that makes them cash flow predictable. And that makes them great, potentially, for people who are looking for a reasonably steady income stream, a known redemption amount, because they've got an obligation in their own lives that they need to meet at the end of that period. Now, shares are less so. Some shares behave a bit like bonds. They offer steady dividends, think of utility companies and so on, but there's no promise. And there's no promise to redeem them at a particular point in time. There might be a share buyback, but that's different. So if you're not getting certainty of income from shares and you're not getting any promise of repayment, what are you getting? Well, historically, past is no guarantee of the future, of course, I have to say that, but historically, typically, you're looking for a better overall level of return over the long term and subject to the correct investor behaviors that I cover in other videos. So that's point 1. Bonds and shares offer different cash flow profiles. Diversification was point 2. Now, both of these assets are good diversifiers. Diversification is the idea of spreading risk. So at the highest level, the sort of asset category level, many people own a property. So they've invested in property, their own home, for example, possibly something for their children if they're able to do that, possibly a holiday home, possibly a buy-to-let. So there's property, shares, bonds, and then of course there's cash. And all of these asset classes behave slightly differently. So diversification is possible across asset classes, and a typical long-term portfolio will have a bonds element as well as an equities element. And within those asset classes, so within the world of debt, bonds, for example, you can get high, medium, and low yield, depending on the issuer, depending on the risk. And within the world of equities, if you are looking to generate income from shares, and some people do, some people don't, again, there are higher, medium, lower yields according to risk profile and so on. You can also diversify across geographies with both. So take the government market, for example, it's possible to buy different types of government bond. Typically, you need somebody to do that on your behalf in a portfolio, or perhaps via a fund. Shares is the same, and you get different security types as well. So in the bonds world, for example, most bonds are fixed coupon, but some have variable coupons. With shares, some people buy growth shares, some people buy income shares, some people buy a mix of the two, and so on. And the important thing when it comes to diversification is to remember that because they are different in terms of the features, bonds often counterbalance equities. So quite often the reason people run them as 2 horses side by side in a broad portfolio is that when the economy is doing well, shares will offer growth. But right now, for example, with a bit of uncertainty around sort of third quarter of 2023, bonds have started to kick into life. yields have started increasing as basically people start to ponder where the economy might go next. I mean, very broadly speaking, when conditions are optimistic, shares tend to do well. When conditions are a bit rockier, less stable, bonds tend to do well. Not always historically, but that's a general rule of thumb, so they kind of counterbalance each other. And then we've got security. I said I'd come to 3 points in this video. Bonds are often viewed as a safe haven. Not all bonds are rock solid safe. It all depends who the issuer is. So government bonds are generally safer than corporate bonds, for example. And for some people, because of that safety element, because you've got a promise of the return of capital, you've got a promise that coupons will normally be paid, especially when you're talking about government bonds, because the UK government's unlikely to go bust. Some people see them as a cash equivalent. So they view them as some way they can put cash to work potentially with half an eye on those foreseeable calls on capital that I talk about in other videos. So getting the balance right, I mean, basically, this is the tricky part. Do you go 60% equities, 40% bonds, 90-10, 50-50? Well, that requires a conversation. Can't answer that in this video. That will depend on your objectives. As I mentioned, are you trying to meet those foreseeable calls on capital? Are you setting up a rainy day fund? Are you looking further out to your lifetime savings? Timescales, when do you need the money back and so on? What sort of cash flow profile do you need in the meantime? And of course, your risk tolerance. The proportion of a portfolio in shares versus bonds at the top level will depend on what sort of risk you want to take. And even within those categories, the extent to which you are invested in high, medium, low yield and so on will depend on what you're trying to achieve in total. And finally, there's the overall investment approach that you want to take. Are you trying to run a growth objective? Are you trying to run an income objective? Are you trying to blend the two? And so on. Okay, so lots of stuff covered in this video and in part one. To find out more about some of it, you could go to my comprehensive video library. That's killick.com/learn. Have a look down this side. There's a tab there, all about bonds, basically. If you want to read all about it in a slightly more commercial context, then Confidant is our quarterly magazine. That one's editor@killick.com. And I have a series of guides. The one next to me is called How to Invest in Equities. There are other guides in the series that do talk about bonds in a bit more detail. So for a copy of those, editor@killick.com.